Okay, so welcome back to Law and Crypto. My name is William Kraus, and I'm an attorney focusing on litigation, governmental investigations, and other disputes related to digital assets, blockchain technology. As always, this is your friendly reminder that why I'm a lawyer, I'm not your lawyer, so nothing I say should be taken as legal advice regarding your specific legal situation or investment advice of any sort. I also need to make clear that everything I say is my personal opinion and not necessarily the opinion of my law firm, and my comments are being offered for entertainment and discussion purposes only. It's also going to be considered attorney advertising in some states. So as always, if you do want to discuss your legal issue, please feel free to contact me directly. Also feel free to follow me on Twitter at WKrausESQ. So with out of the way, let's start our discussion. So since we spoke last, kind of a lot has happened. In short, the market kind of imploded and it's getting pretty nasty out there with what I consider to be a lot of market contagion spreading across numerous crypto firms. So as you probably know, this all kind of got started with Terra Luna, which I've spoken about, and then we saw Three Arrows Capital or 3AC. And then about a week ago, we saw problems with Celsius. Now, this sort of ripple effect across crypto might be over, or more likely it is still going to continue for some time. And today I thought it would be helpful to talk a little bit about what happens in the past we've seen with financial collapses, in traditional finance and legal regulatory expectations around this crypto fallout right now that's going on. So with that, let's dive in. So if you're tuning in, you probably don't need much of a background on Celsius, but long story short, a major crypto institution offering high yields to retail and institutional investors seemingly has encountered liquidity issues in light of a massive market downturn. Withdrawals have been halted and people are now worried. I'm going to share my screen here so you can see what I'm talking about. All right, so you should see crypto lending firm Celsius pauses withdrawals and transfers citing market conditions. This is the block. Talks a little bit about what's going on there. So what ultimately ended up happening, or what ultimately will end up happening, remains to be seen, right? But in many ways, the fallout has already begun. For example, Celsius announced, like I said, about a week ago, be pausing withdrawals, and pretty much immediately there were news reports coming out. The SEC was in communication with Celsius, as well as state-level regulators from Texas, Alabama, New Jersey, and Kentucky. Now, as I read about Celsius and all the things that tend to play out when things go sideways from major companies, I thought it made sense to work through what's going on with them and how it might relate to what we see in the coming months with other companies. So let's talk about the states first. So we've got Texas. All right, so Texas, other states, open investigation of Celsius network. This is CoinDesk. And you might recall that this actually isn't the first time Celsius had to deal with something. Back in September, Celsius was actually issued a cease and desist order from Kentucky, New Jersey, and Texas, basically on the basis that the interest-bearing products offered by the company were akin to unregistered securities under those states' blue sky or securities laws. And while this might seem a bit random, these four miscellaneous states just coming out of the woodwork, it really isn't when you start to think about it. Why? Well, companies like Celsius, based in New Jersey, have been on the radar of state securities departments for some time, as well as attorney generals for some time. And they, those that have been paying attention the last 2 years are going to be very keen on investigating firms now that they've run into issues or, perhaps worse down the road. So what do I mean by on the radar? Well, some of these states, and in fact, some of the same states investigating Celsius now are also investigating BlockFi, issuing them cease and desist orders, for pretty much the same thing. That is, say, using their BIA account or their BlockFi interest account, constituted unregistered security. And in fact, a number of states investigated BlockFi and issued orders, like Iowa did just 6 days ago. So it seems a little late to the party, but this came out, just last week, that Iowa had fined or, ordered BlockFi to pay $943,000. What's going on here? Well, anywhere where a financial firm does business, whether it's through having customers in the state or making services available to a state's residents, among other jurisdictional bases, it's sort of fair game for a state to announce that the company is therefore doing business in its jurisdiction and is subject to its securities laws. That's exactly what happened with BlockFi. In fact, BlockFi was faced with what was known as a multi-state working group made up of a few dozen state regulators who collectively investigated whether BIAs involved the offer and sale of unregistered securities. This working group actually coordinated with the SEC and the BlockFi settlement that they had earlier this year. And since then, which I've seen in states like Iowa, issuing their consent orders or settling one by one. And I think that's exactly what's going to happen with Celsius. And perhaps the other US firms that are going to struggle in the market downturn, particularly if the state at issue is trying to make a name for itself in terms of crypto regulation. And my favorite, go-to state when we're talking about crypto regulation is New York. I would be shocked if New York does not end up investigating Celsius or having some sort of involvement with them in light of all this. And to be clear, a whole lot of states can and do jump in when really all they need to do is say we're joining a working group or issue a subpoena. Is this new and unique to crypto? No, absolutely not. Are they picking on crypto? No, this has been seen time and time again. And it's just an example back about 10 years ago when the LIBOR debacle was unfolding. And I'm not sure if you remember that, but that was sort of one of the largest financial scandals that had taken place up until then. There were something like 42 states that banded together to investigate and get a chunk of the settlement funds that ultimately were paid out by the banks that were associated with that. Now, here I expect the same thing. Now, in short, if a business in the US has US customers or markets itself to US investors, there's going to be some sort of risk of a state investigation there, unless the company has expressly barred customers or investors from that state. And even then, if those bars are not effective, this still might be an issue. What about the federal government, on the other hand? Well, as it relates to Celsius, I think that's probably a foregone conclusion, as it's been reported that the SEC is already talking to the company. But will it end there? Well, probably not, unfortunately. Now, to explain, what we've seen in the past with financial collapses is that usually it comes out there were even worse things sort of happening in the background than we even knew about. Whether we're talking about run-of-the-mill market manipulation or things that are larger in scope, backdoor deals, et cetera, et cetera. We usually find out that when the dust ultimately settles, subpoenas will start to fly as we figure out what actually was going on at the darkest sort of moments in a collapse. And looking to past financial fallout, I would not at all be surprised if the past few weeks ultimately lead to some CFTC investigations or maybe even a DOJ criminal investigation, depending on what ultimately comes to light. And to be clear, in any global market like crypto, there will be international regulators as well, other governmental organizations paying attention. And while the US definitely is the most active in terms of this kind of investigation, Celsius was a big shop. And, they offered their services to customers around the world. I would not at all be surprised if regulators in other countries like the UK, for example, got in on the fun and started investigating, but we will just wait and see. So that's sort of the governmental, law enforcement regulatory side of things. On the other hand, you have civil litigation. Now, to be sure, the class actions will be rolling in. I know King and Isaiah spoke about this last week, but we already heard that BitBoy or Ben Armstrong was threatening a class action related to his inability to withdraw funds. And he later appeared to walk away from that on this tweet here, saying essentially that we don't believe we can win due to the TOS, even the successful attorneys make most of the money. And sure enough, if you look at the terms of service or terms of use, boom, right there, I highlighted for you. There's big, bold, all caps, waiver of class actions. So, that's pretty common, with a lot of these terms of service or terms of use with crypto companies. There's also often arbitration provisions like we see here, that might require certain users to go through a dispute notice process and binding arbitration instead of the court. Now, that said, I've dealt with a lot of class actions, and I still expect that there are probably lawyers out there who are going to try anyway. They either will, one, ignore the class action waiver altogether and then ultimately leave it up to the courts to decide if they should get bounced as a matter of law on a motion to dismiss, or two, they try to write their way around the waiver and argue it doesn't apply. There's a huge financial incentive to do so, given the number of victims or people who've lost money or who might lose money in the future with some of these firms collapsing. So, somebody else is probably going to try. And I could get in a little bit of the nitty gritty on that. I mean, they might argue that the waiver was unconscionable, it was one-sided, it's so sort of one-sided to shock the conscience is basically the standard. And it's a pretty tough standard to prove given how prevalent these kinds of provisions are in commercial contracts, but, it doesn't mean you can't try. And more broadly speaking, I think you're going to see a lot of litigation flowing out this time. I mean, not just class actions. You might actually see individual lawsuits. You might see a ton of individual lawsuits or consolidated on multi-district litigation. Pretty much in any financial crisis, you see the large companies are the ones that immediately get hauled into court for any variety of reasons. usually having to do with mismanagement of risk, customer loss, other harm to the little guy. I mean, you can, anything from, issuing a bad mortgage-backed security to, the market was collapsing and your trading engine shut down and I couldn't exit my position I wanted to. This will spawn years and years of litigation if it gets really bad, because we've seen it before. And it's definitely not, like I said, when things get down, chips are down, sorry, people are losing money, litigation starts flying. And I'll reference back to LIBOR, because I think it was a good sort of, example of what happens here. That was basically the London interbank offered rate. And as a quick background, it basically had to do with a rate that a handful of bankers said they would loan each other money at, on any given day. And they would take that rate. Various panel banks would submit that to an association, and this benchmark rate called LIBOR would be generated each day. And the problem was LIBOR was tied to a number of interest-backed products or interest-type products. So it was like mortgages or car loans or student loans, anything, under the sum of interest might, or very well at the time, had a LIBOR connection. So LIBOR plus, how many basis points. So, people, if it turned out that people were manipulating it for their own benefit, as was found to be the case, you can imagine the fallout, because this was tied to trillions of dollars of notional value. Now, in the US with LIBOR, we saw dozens and dozens of class actions, and you really sort of have to think about this from all sides. With LIBOR, you had the people who were damaged because the interest rate was too high, like say the student, who borrowed money and paid too much in repayment, because LIBOR was high. On the other hand, if LIBOR was manipulated down, you had, in that example, the lender to the student loan who collected less money than they should have. So if you take the people who sort of benefited or, were harmed, depending which way the market was moving, or, you apply it to all the different financial products that LIBOR touch, you can see how this can proliferate, and you can have hundreds of classes, the class of investors in this product between this year, the class of student loan, issuers between this year and that year, et cetera, et cetera, et cetera. And the LIBOR thing was nothing compared to what ultimately happened with the 2008 financial crisis. There you had tens of billions of dollars in fines get issued and dozens more class actions related to everything: mortgage bonds, foreclosure processing, mortgage-backed securities, et cetera, et cetera. Now, will we have the exact same thing in crypto if we enter, this huge bear market and there's this giant sort of contagion and financial collapse across all these different companies? Well, I mean, probably not exactly, because the regulatory and jurisdictional structure around major banks is a lot clearer with, your brick and mortar financial institutions than with crypto firms. But, here's the thing: as you have more widespread adoption, and you have pension funds and 401ks holding crypto, and you have states who are sort of trying to regulate it and build out, sort of enforcement frameworks around crypto companies, and more companies enter the fold as investors, the downside is going to be that much worse given the size and how big the market's grown when something goes wrong. And when, we entered a bear market back in 2018, I think it was a different story. I mean, yes, we've seen this time and time again, but each time the crypto market is bigger and more people are harmed and more money in terms of sheer notional value is lost. So, as you have this increased adoption, I think, you're going to have much more private litigation. You have much more governmental investigation, taken with the fact that everybody's sort of IQ regarding crypto and interest in crypto is much, much higher now than it was in previous downturns. And to that end, let's talk for a minute about regulation. So now I don't need to spend a whole lot of time on this. I was trying to close my screen share, but I can't find the button. There we go. But in short, there already was a ton of focus on crypto regulation before this all started. And what we see usually when there's a huge financial collapse is that you get increased regulation, aimed at sort of stopping the cause of the past fallout, or, protecting consumers. For example, 2008 eventually led to the Dodd-Frank Act, or more properly, the Dodd-Frank Wall Street Reform and Consumer Protection Act. If you want to see what the real sort of motivation is there, which really focused on the underlying causes of that financial crisis while upping the ability of regulators to police the market. And I think you're going to see the same thing here. Sorry to break this to you, but I think things are going to get much more aggressive in terms of regulation as a result of this collapse. And what specifically happens is going to be hard to say, but it's going to depend on political will, consumer harm, lobbying, a number of factors. But I would expect that if you had a collapse that was sort of teed off by a major algorithmic stablecoin collapse, you're probably going to see some increased regulation around major algorithmic stablecoins. I also expect you're going to see increased pressure to silo risk between crypto firms, sort of more guidance around, how stablecoins might hold their reserves, et cetera, or things that are trying to sort of prevent the systematic risk of, collapse. You get crypto big enough and you really are going to start running into the risk that you're going to have fallout spread into other markets, and governments hate that. You're going to probably see crackdown on high yield investments, piggybacking on DeFi and other highly volatile sort of underlying instruments. And, on that note, I'm going to end my session with a searing hot take. I mean, while the government was entering the fold before and has many motivations to do so that go beyond, preventing systemic risk or protecting investors, I think crypto as an industry didn't do themselves any favors here. I mean, we've talked about, in hindsight, wow, the market was really crazy. And you had people on TikTok flipping NFTs for hundreds of thousands of dollars. And, maybe it was inevitable, but we didn't do a great job, just like the large banks did, when they were issuing very, very risky investments or doing a bad job of sort of managing their risk, as institutions, or sort of gambling with ordinary people's money, the ordinary investor is usually the one who gets demolished as a result. And governments are not usually happy when that happens, right? So governments aren't going to stand by and let this keep playing out every 4 years with crypto. If certain large players, and I'm not going to sort of name names of, those that have been falling left and right recently, but they're not going to do enough to protect the market and the customers on their own. Hate to break it to you, but the regulators will force them to do so. And that's what I've got for you today. Hope you enjoyed our talk. I will be back in about 2 weeks, and, who knows what's going to happen between now and then, but I will be here to talk to you about law and regulation, and stay safe out there. All right. Thanks.